With around 5,000 options on the market right now, which mortgage product do I bloody pick? In this video, I'm going to show you how a 5% mortgage could actually cost you less than a 3% interest mortgage. So there's a few different things that we need to analyze for a mortgage that we're going to buy our property with. Now the first one, let's get the obvious one out of the way, is interest rate. Now, obviously, you're going to make a decision based on the interest rate because, in the most part, a 5% interest mortgage is more expensive than a 3% interest mortgage. Well, surely, Jamie, it's all the time. Well, no, actually, and I'll go through that in a moment. So, how do you actually pick how long you're going to fix it for? And this is the key with this because there are 2-year, 5-year, and 10-year. They are the most typical. There's actually a 3-year as well, but not many people talk about them. They're pretty much irrelevant for now. Okay, so what one are we actually going to go for? Well, we're going to base this on the interest rates, right? Now, with 2-year mortgages, a majority of the people went for 2-year fixed mortgages. And because these were the most popular product, they had something like 2,000 different products. They were trying to push it out to as many people as possible. And so it reflected the cheapest rates. But since then, there's been two things. There's been economic and political uncertainty, i.e. the world has gone to shit and the government can't be trusted. Shock horror. Okay, but so because of that and that uncertainty, a lot more people are actually going, you know what, instead of these 2-year fixed, maybe I kind of want to dampen it down and protect myself a little, and more people have been switching from these 2-year mortgages to the 5-year mortgages. And now naturally, because of that supply-demand ratio, the interest rates on this, a 2-year mortgage, to a 5-year mortgage has started to go down. You'll still pay slightly more for a 5-year mortgage, by the way, but typically what I'm finding is around a 0.5% difference per annum in cost. So when you look at that 0.5% difference, you have to bear in mind, let's say it's a 100,000 mortgage, not purchase price, actual mortgage, so loan that you're getting, that's representing £500 per year. 0.5% of 100,000, 500 a year. Therefore, over a 5-year period, that's an increased cost of £2,500. So you are paying £2,500 more, or are you? So I'm going to get down to the breakdown of the prices in a moment, but the other thing that you want to be thinking about with this is your risk appetite. Now, a lot of people don't actually think about this. They kind of go, yeah, get the best rate for me. But actually, what is your personal risk appetite? Now, let me explain. I've mentioned a few times, I'm pretty boring. I'm vanilla. I love buy-to-let. But I'm also pretty boring and vanilla with my investments. And what I mean by that is, so I value the return of the investment over the return on the investment. And what I mean by that is, my number one thing in investment is the preservation of capital. And I don't like risk. And the reason I don't like risk is I like focusing on growth. So I actually take quite an exceptional amount of risk in my active day-to-day activity. I'll throw marketing spend, I'll be on the phones, I'm closing, all of those sort of things. And I take pretty big risks in my business. I hire a lot of people. There's a lot of cost implications. So with my passive income, i.e. my property investments, my stocks and things like that, I want it as safe as possible. So whilst I'm trying to aggressively build a portfolio and I'm buying, 3 to 5 every single month that I'm trying to build up right now, I kind of want to know my interest rate is my interest rate. But if you're in a situation where actually you think interest rates are going to be like that for the next 5 years, maybe paying an interest rate here isn't going to make sense for you. Whereas if you think the market is going to go like that, then obviously it might be for that. Now for me personally, and I'll get to what I end up doing, but I like protecting myself to a level, so there'll be a bit of variety in there, but ultimately we are still pretty much at all-time low in interest rates. So when you're at an all-time low, what's pretty much the only way that it can eventually go? Up. Right? That's just logical. Am I saying it's going to happen in the next 6 months, a year? No, I don't know for sure. right? But I know it's not going to go down too much, and the drink I'll get if I go down rather compared to the hurt of it going up, it's not really comparable, going to get hurt a lot more. So what is your risk? The next thing to decide is if you are going to go for interest only versus capital repayment. So a lot of people actually ask me, well, what happens at the end of an interest only mortgage? Well, I've got you covered. You can click here, it will open in a new tab, and make sure you watch this video after finishing this one. Let's jump back in. So I massively prefer, and in fact I will only buy with interest only mortgages. Now you watch the other video, you'll understand what happens at the end and why I'm not particularly worried, but more the fact that this gives me an opportunity. Just because it's an interest only mortgage, let's say your loan is here, and obviously on interest mortgage only it doesn't go down. On capital repayment, let's say this is over the term, it goes down like this. So at the end you don't owe anything. But for me, I like the flexibility. So just because I'm interest only doesn't mean I don't need to pay down. I very rarely do, by the way, because the market goes like that in the grand scheme of things. So, but it does give me the opportunity up to 10% a year to go, you know what, at the end of the year, I've got a load of money sat there. I'm not looking to place it anywhere. I might just pay down a bit. So it'll go like more like this. But I'll just keep on going as I want to go along. But capital repayment is kind of locks you into something that I may or may not want to do. And if there's some sort of variation in the cost implications, then I could very suddenly be getting negative cash flow in. Instead, I like focusing on interest only, cash flow in as much as I can. And if I want to chip away at the debt that's there, i.e. the mortgage, then I've got the choice to do so. Finally, let's go through the actual cost, and this is going to give us that 5-year comparison metric. So remember, if we said the 2-year is at X costs, just a bit of algebra for you, and 5-year is costing you 2,500 on top, so that plus 2,500, right now the 5-year looks a pretty stupid idea to move forward with, right? It could be, but let me go through some costs that you're going to have at the end of this. Just a reminder that 2.5 grand represents a 0.5% increase. That is what I am coming up against. However, if you want personal financial advice, I'm not your guy for it. I'm not financially qualified, and I recommend you reach out to a qualified investment broker for this. But let's go through some charges. First of all, and I'm going to put this in this color, you've got ERC. This is an early redemption charge. The reason I put it in that color, and unless you're an idiot, you don't need to pay that. At the end of your fixed year term, you need to refinance it. Don't do it 1 year into your 2-year fixed term, because you can get charged an early redemption charge. A majority of the time that will be at around 5% of the mortgage value. Not a nice cost. So I'm not going to put the cost of that down, but it is up to 5%. Okay, which is really not a nice cost to be coming up against. But what else do you have at this point that people don't think about? Well, first of all, you've got your broker. You are going to end up having broker fees. We pay £500, and it's a bloody good broker. Honestly, you can pay between 500 and 2,000 upwards. And all I'll say on that is price is what you pay, value is what you get. The next thing you've got is something called a deed release. Essentially some admin, and that will cost you anything between £50 and £300. Let's call it 150 to make it an average on there, but that is something you are going to need to pay. The next thing is you're going to have to pay a set of legals again. I know, why do I have to pay legal fees? Well, you have to do that. Now, it's slightly cheaper than a purchase, but right now we're paying around £500. Historically, you could get it a lot lower, but honestly, I've seen people, because there's so much demand for solicitors, a good solicitor right now, I've seen people get paid north of £1,000. But let's say £500 for that. The next thing, we've got a booking fee, which is very typical, normally around £200. And then finally, you've got a valuation fee. So naturally, if a bank is going to go out there and revalue the property, that's going to cost you a bit of money. Normally, that's going to be around £400. Now, you can get them cheaper, you can get them more expensive. A lot of people will incorporate this into the lending. So there's a few things to factor in on that. So your fees here are 500, 500, 1,000, 1,600, 1,750. So again, right now you go, well, it's still worth getting the 2 year over the 5 year, isn't it? Well, it depends what you're then going to do, because making the assumption that you're constantly going to pick a 2 year over a 5 year, then it's going to cost you 2 sets of that. In fact, over a 10-year period, you're going to have 5 sets of that. But let's say 2 of them, okay? So that's going to cost you £3,500, plus you are risking an increase in your interest rates going up. So you really need to factor everything in. So the question you might be asking is, Jamie, what is it that you do? Now remember, this isn't financial advice, but this is what I'm currently doing on my portfolio. I personally recognize that interest rates are still at a relative all-time low right now, and I want to take advantage of that. I also don't see it going anywhere in the next couple of years, but I do feel there is some way to go for capital growth, and I want to monetize on that. So the way that I'm doing it right now is I personally am purchasing on 2 year, even though I've just gone through that, 2 year fixed interest only in my company bank account, okay, and company purchase, sorry. And then what I'm doing is adding a bit of value, getting it rented out, and I am revaluing and refinancing the property at that 2 year mark. Now I'm willing to take that risk because of 2 reasons. Number one, I'm taking a bit of a gamble that the value of the property is going to be higher 2 years from now than it is today. But also I'm taking a bit of a gamble that I don't think interest rates are going to rise. Now naturally I will assess the political and economic environment at the time, but my current plan at year 2, and a lot of those are coming through, is I'm then refinancing on 5 year, or if they are available, potentially 10 year fixed. And the reason for that is I want to aggressively build my portfolio, because it's not just the risk of all of this, it's also my time implication. And as I'm building my businesses, my time is becoming more and more valuable, and you need to value your time too. A lot of people don't even think about the return on the investment of your time inputted in there. So that's my opinion. What would be amazing, whether you're a broker, a newbie to property, is what is it you're going to do? What is it that you're going to do with your purchase moving forward? Let me know what you thought about this video in the comments. And hey, if you want to understand why I think interest only is better than capital repayment, make sure to watch this video after this. And hey, if you're new to the channel, make sure to like, hit the subscribe button, and of course the notification bell to be notified when my next video is coming up in 2 days.